Now, welcome back. This is Taking Stock on Bloomberg. China surpassing the United States as the world's biggest automobile market, a milestone that comes courtesy of a $500 billion stimulus package that has not only raised sales for companies, but it's raised a lot of investor hopes. Billionaire investor George Soros calls China a positive force that will help drive the global recovery. Let's get some details on China's role in that recovery. My guest is Jing Ulrich, who heads up China Equities for JPMorgan Chase in Hong Kong. Thank you very much for coming by and visiting with us.
Thank you.
What is the story right now with this $500 billion stimulus package in China? Is it as successful as all of Wall Street makes it out to be?
Well, the stimulus program has been remarkably successful in the last 6 to 9 months. Now, what's been happening is that the stimulus program was a mere catalyst to get the economy going in the fourth quarter of 2008. And what's been happening since then is that confidence in the overall economy has been rebuilt. Therefore, we're seeing very strong numbers in consumer spending. We're seeing 48% surge in car sales just in the last month alone. We're also seeing 40% increase in home appliance sales. In addition, you've got a massive infrastructure program that's underway. So the economy is absolutely humming.
All right, so if the economy is absolutely humming, does that mean that investors should be investing in companies that do things like make steel, companies that supply iron ore, copper, industrial metals? Is that a place to be?
Well, a lot of the stocks in the commodity space have run. They started going up starting in the second quarter of this year in anticipation of stronger Chinese demand. Also, in the first half of this year, Chinese imports of commodities have reached record levels, from copper to aluminum, from iron ore to even oil. Oil imports did not reach record levels, but they were up year over year. So to benefit from China's growth, investors can consider investing in companies outside of China, in Brazil, in Australia, in the Middle East, that supply commodities to China, as well as the Chinese producers themselves.
Now, do you think that those valuations have already exceeded real fundamental levels?
Well, in some cases, they might have run too hard in a short space of time, but we have a bit of a correction going on right now with oil prices and other commodities. But I think given we have a bit of a summer lull here in other markets, not in China itself, but in the fourth quarter of this year, I think commodity prices are going to be stronger than they are today.
So this isn't just an inventory build. There's real economic fundamental growth underneath all this.
Well, end demand is recovering. If you look at housing sales, they've reached record levels in the last month. House prices have also recovered. So in anticipation of stronger demand to come, property developers must start building new housing. 9 months ago, some of these developers were actually looking at possible bankruptcy. But today, they're looking at potential shortage in the first half of 2010 if they don't build fast enough.
And this is all because the government has not only provided the stimulus, but also has changed some of the tax laws around, let's say, real estate ownership.
It's not just the overall stimulus package. I think it is actually consumer confidence. The money was always there. Even in the dark days of fourth quarter 2008, the money was always there. China has $8 trillion in bank savings. The reason why people stopped spending in the fourth quarter of 2008 was because uncertainty and lack of confidence. Now that confidence has been rebuilt, consumers are back now spending, buying homes, buying cars.
What about the export side of the economy? Because it seems as though if you've got something that is this big, this focused, how do you change from being something that's export-oriented to something that now is the domestic economy? Was it that big before?
Well, the export economy remains struggling because of the external environment. So in the last 6 to 7 months, every single month, we've had a decline in exports, down 20%, 25%. It will continue to be a challenge for the rest of this year. However, what's encouraging is that spending is now happening in inland China. The export economy will continue to struggle for the next 6 to 9 months until the U.S. and European economies recover. However, we're seeing such strong momentum in inland China that's offsetting some of the weakness in the exports sector.
What about some of the geopolitical problems that China is facing, whether it be the Uyghur rioting that took place in parts of Western China? Is that of concern to investors?
Well, political risk is a concern for investors, not just in China, but everywhere. Certainly, social stability is of paramount importance to the Chinese leadership. We've had periodic flare-ups, not just in Western China, but other regions as well. But I think the situation will calm down.
And do you think that the government has the social programs well in mind, such as health care, such as pension? Are those areas also you're going to see a lot more money flow into?
There will be huge amounts of money to be spent in social welfare. $123 billion will be spent in the next 3 years on building a healthcare program. So that's going to give 90% of the population some coverage, basic coverage. By the year 2020, the Chinese government has pledged to have universal health care for the entire population. And in addition, education, pension services are going to be provided for as well.
All right, we're going to continue the conversation. Stay with us. We're going to talk more with Jing Ulrich. She runs JPMorgan's China equity business. We're going to talk about financial stocks, healthcare, as well as life insurance. Find out where you should be allocating capital to specific companies. This is Taking Stock on Bloomberg. I'm Pim Fox. A programming note, Taking Stock begins each weekday at 3 p.m. Eastern on Bloomberg 1130 a.m., as well as on XM Channel 129 and Sirius Channel 130. This is Taking Stock on Bloomberg. I'm Pim Fox. A fundamental shift underway in China. The government striving to move from an export economy to one that depends on consumer spending. As part of the effort, see if this sounds familiar, a plan to introduce, as my guest Jing Ulrich of JPMorgan said, healthcare, introducing healthcare reforms. So what kind of stocks are going to do well in China if that actually takes place?
Well, you have pharmaceutical companies, both in China and outside of China, medical equipment companies, hospital companies. But in addition, if the healthcare program improves, the consumers are going to have more confidence spending more money rather than saving all their money for the day that they get sick. So that's going to help overall consumer spending. So in general, consumption should benefit if the social welfare program is put in place.
Talk about this notion of the emerging middle class in China. I mean, is there a bottom-up movement to have this middle class, or is this something that could disappear very quickly because it's fragile?
I think the emergence of the Chinese middle class is unstoppable. You have roughly now 400 million people who are now middle class already. They live in the urban areas, they have well-paying jobs, and they have homes and cars already. Every single year, the population that's considered middle class grows and grows rapidly. I would say probably every year you have another 50 million people joining the ranks of the middle class.
Another 50 million people every year joining the middle class ranks.
Just like every single year, you've got 20 to 30 million people moving from the countryside to the cities.
So does this mean that consumer discretionary stocks would do very well, or even things that we've come to take for granted, whether it be mobile phone service or whether it be water filtration systems? All of these things are set to prosper?
Well, consumer discretionary companies have been doing very well in China already. If you look at retail sales, real retail sales growth in China is around 15%. You talk to sporting goods companies, department stores, other retailers, even jewelry companies, they're seeing their sales booming in China. Everyone in China aspires to a higher standard of living. Income growth has been in the region of 15 to 20%. In addition, people have huge amounts of savings. If you look at household savings alone, it's about $4 trillion. That's a lot of purchasing power.
What about trying to get that purchasing power active into the economy? What are the headwinds that the government and that individuals face? I mean, many times we hear that there is a predilection to save in China. What are the obstacles that have to be overcome?
Well, the propensity to save is natural. There's a cultural reason. There's also the lack of low social safety net. People tend to save a lot because, for their retirement, they're worried there are no retirement funds that they can rely on. But in the future, if the social welfare program is actually successful, I think consumers will feel much more confident spending more and saving less. If the savings rate goes down from the current 40% to, say, 30% or 25%, that is going to unleash a huge amount of purchasing power among the Chinese consumers.
All right, we're going to continue the conversation. We're going to have more with my guest, Jing Ulrich. She runs the JPMorgan China equity business. We're going to turn to the question that everyone wants to know. Can China pull the world out of a recession? We'll find out. Also, what about financial stocks in China? If there is an emerging middle class, aren't they going to need banking services? We'll find out. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. My guest is Jing Ulrich. She is the chairman of JPMorgan's China equity business. Jing, one of the big questions everyone always asks is, okay, if the Chinese economy is doing so well, will it lift the rest of the world out of the global recession?
Well, the Chinese economy is already the second largest economy in the world. This year, China will surpass Japan. In terms of absolute amounts, China is 5 trillion in size. The U.S. economy is 14 trillion. Now, in terms of spending in commodities, China is #1 in the world, with the exception of oil, where the U.S. ranks #1. So, in effect, China's growth, China's overall stimulus program, and spending in the last half year have already lifted the growth rates for the world economy. However, China only accounts for 8% of the global economy. But this year, the entire growth of the world economy is essentially coming from emerging markets, namely China, India. So China is a huge share of the global growth already, so therefore already helping lift the world out of recession.
Now, this is not a new theme in a sense because, in the past we had many U.S. banks, for example, make investments in Chinese banks, Chinese financial companies. Some of them have had to sell those holdings in order to raise capital. What about the financial sector inside of China?
The financial sector in China is enjoying tremendous liquidity. If you look at the top 5 banks in the world, 3 of them are in China. The largest single deposit-taking institution is a Chinese bank, ICBC. If you look at loan growth, we mentioned earlier, so far this year, Chinese bank extended 7.4 trillion yuan in new loans. That's over $1 trillion, accounting for 25% of the country's GDP. Now, I think loan growth might have been too excessive in the first half of this year. However, the so-called loan-to-deposit ratio is only 67%, meaning the Chinese banking system is still enjoying tremendous liquidity.
They have a lot of cash in the banks, and they haven't been able to even lend out what they have.
That's right. In other countries, in the Western countries, the loan-to-deposit ratio is well over 100%. So Chinese banks still have more capacity to lend. But of course, they need to pay attention to risk management as well.
What about investing in companies, let's say, that are based in the United States or in Western Europe that do business in China? Are there specific industry groups where you see huge domestic demand for foreign goods, services, or expertise?
Absolutely, across the board. From jewelry to luxury goods to daily consumer products to vehicles, there's tremendous demand for every single category of consumer goods from the Chinese middle class.
What about the infrastructure that is being built in China, whether it be transmission lines or whether it's power plants or, I mentioned the water filtration systems. We've had people on the program talk about just creating clean water. Are there specific areas that you think are in greater demand?
Yes, railway construction. Chinese railway spending so far this year is up 300%. China is building some of the best, fastest trains in the world. In terms of building ports, bridges, airports, China leads the world. In terms of renewable energy, China has a big program going as well to reduce the reliance on coal. And also, water quality, of course, is quite important for the consumers as well. China has a major shortage of water, especially in northern China, where you have a very arid climate. So any kind of technology that is going to help China with its overall economic development, all the industries I mentioned, I think stand to benefit tremendously in the years to come.
What about food and food production? What about the agriculture sector? Do they still import food, and are there areas that are in greater demand, such as pesticides, herbicides, or even fertilizer?
Well, in China, most of the food grains the country is self-sufficient in, except for soybeans. China is the single largest importer of soybeans in the world, and the United States is the single largest supplier of soybeans. But in terms of wheat and rice and even corn, China is self-sufficient. But increasingly, the Chinese middle class is consuming a lot more protein. So more protein, of course, means more need for grains. So in the years ahead, I think the Chinese government needs to focus on increasing agricultural productivity. So farm equipment, fertilizers will also do very well in China.
All right. I want to thank you very much, Jing Ulrich, the chairman of JPMorgan's China equity business. I appreciate your coming. Looking forward to having you back. We haven't even talked about the U.S. dollar and China policy there. Look forward to having you back in the future. Thank you very much.
It was a pleasure.